Hi everyone. Today in Financial Accounting, we'll be discussing Chapter 1, Uses of Accounting Information and Financial Statements, focusing on Objectives 5 and 6. In Objective 5, we're going to be discussing how we communicate through our financial statements, and in Objective 6, we're going to discuss how generally accepted accounting principles and the CPA's report relate to accounting. So let's start with Objective 5 and identify the 4 financial statements. Financial statements are the primary means of communicating important accounting information to users. They represent the business in financial terms. However, we need to keep in mind they are not a perfect picture of the real thing because, in actuality, all financial statements are prepared as of a specific date and you're getting that information after it has already happened. There are 4 primary financial statements that are issued by a corporation. They are an income statement, a balance sheet, and a statement of retained earnings. And lastly, the cash flow statement. Let's start with the income statement. Income statement, or statement of operations as it's otherwise known, basically summarizes the revenues earned and the expenses incurred for a business over a period of time. Revenues basically increase the stockholders' equity, and they're resulting from the actual operations of the business, while expenses decrease the stockholders' equity that results from the operations of the business. Businesses can either show a profit or a loss for a specific period of time. A profit is just simply net income. It's revenues that are exceeding expenses, whereas a loss or a net loss is when expenses exceed revenues. Some people consider the income statement to be the most important financial report because it shows whether the business achieved the profitability goal. In terms of the order of the preparation of the financial statements, the income statement is typically prepared first before any of the other financial statements because the profit or loss that is achieved by the business is needed to complete the other financial statements. It's needed to calculate the statement of retained earnings, and it's needed to calculate that information on the balance sheet. Let's look at a snapshot of an income statement. Here we see the income statement of Inglot Consultancy. As you can see in the heading, Inglot Consultancy is at the top, the name of the financial statement title is in the middle, and then the period for which it is reporting financial information is the third line of the heading. As you can see, the revenues are reported first, and then the expenses, and then income taxes, and then we see whether we've earned a profit or a loss. Now, as I mentioned on the previous slide, the income statement is calculated and prepared first, and we can trace that net income that's reported or the net loss, we can trace that to the statement of retained earnings. If you would refer to the chart on page 25 in your textbook, that's going to be an important piece of information for you to understand. In that chart on page 25, it shows the flow of the preparation of the financial statements. So just write yourself a little note here to refer to page 25 in your textbook. Again, now we'll move over to the statement of retained earnings. We take that information, the net profit or loss, from the income statement, and that moves over and is reflected in the statement of retained earnings. The statement of retained earnings shows the changes in retained earnings for the business over a period of time. Retained earnings represent the accumulated earnings generated by that business's income-producing activities, less any amounts that have been paid out to stockholders. The primary payment out to stockholders is what we call dividends. They're the distribution of resources that are generally in the form of cash to stockholders. Only the board of directors of a corporation has the authority to declare dividends. So basically, the statement of retained earnings shows all the factors that impact the retained earnings of an organization during a fiscal period. It is also called the capital statement. So let's look at this information regarding the statement of retained earnings in another way. If we look at this flow chart, we can see that retained earnings are positively impacted by the revenues that come into the business. Retained earnings are negatively impacted by expenses associated with the business and dividends. We can show that those are the outflows from the retention of earnings by a business. Simply put again, revenue minus expenses equals net profit or net loss, and that net profit can be distributed to the owners in the form of a dividend. Dividends are just the distribution of assets of a business to the stockholders or owners of the business from past earnings. Usually, those dividends are distributed in the form of cash. Let's look at a calculation associated with the statement of retained earnings. So, as we can see here, we've got the statement of retained earnings, a very simplified statement of retained earnings for Inglot Consultancy. We see that, again, just like other financial reports, there's a heading, the name of the company, the type of report it is, the statement of retained earnings, and then the period for which it is reporting. As we can see, we start out with the beginning retained earnings for that period. So the beginning of the period is December 1st, and the end of the period is December 31st. In between, we add net profit or net income, and we get a subtotal, and then we subtract out any dividends. So, a very important formula that we have in accounting is this formula that we show here. We see that this formula, beginning retained earnings plus or minus net profit or net loss minus the dividends gives us our ending retained earnings. If you recall, during first semester, we did a formula that had to do with the capital account for a business. It went beginning capital plus or minus net profit or net loss minus withdrawals equals ending capital. This formula, as I had mentioned in the first semester, is a very important formula in order to understand the retention for the business of any profits or losses in that business. Okay, so you can see this formula is reflected in this example in this fashion. And this is just very, very similar to what we did during the first semester. Except now, instead of dealing with a sole proprietorship, we're dealing with a corporation. So instead of owners' withdrawals, we have dividends. But remember, the owners of a corporation are the stockholders. So the stockholders can get withdrawals in the form of dividends. Now let's move on to the balance sheet. The balance sheet shows the financial position of a company or corporation at any point in time. It is often called the statement of financial position. It presents the business as the holder of resources or assets that are equal to the claims against those assets. Those claims are liabilities and capital, or stockholders' equity. let's look at that in a little bit more detail. So the economic resources of a business are its assets. Those economic resources must equal its equities. And there are two types of equities. We have what we call creditors' equities and owners' equities. This relates to the accounting equation as such. Assets equal liabilities plus owners' equities. We learned this in the first half of the year. This is your basic accounting equation. The creditors' equities are our liabilities, and the owners' equities are our stockholders' equity. Assets equal the economic resources of a company, and they are expected to benefit the company's future operations. Liabilities, on the other hand, are the business's obligations to pay the cash or transfer assets or provide services to other entities sometime in the future. These are the obligations that a company has. A company's financial position shows the value and the relationship of the business's economic resources and the claims against those resources. So the claims against the economic resources are creditors' equities and owners' equities. In terms of our assets, we can kind of break our assets down into three broad categories. Our monetary items. These would include such things as cash and accounts receivable, and then our non-monetary items. I apologize, my pen here does not write very well. Our non-monetary physical things, and then our non-monetary intangible or non-physical items. Our physical items would include such things as inventory, equipment, buildings, etc. And our non-physical items or intangible items would be such things as patents or trademarks. Okay, so let's now shift gears and look at our financial position. As I said a minute ago, our financial position shows the value of the relationship, and the relationship of a business's economic resources or its assets and the claims against those assets. And then we broke those claims down into creditors' equities and owners' equities. And the creditors' equities are really pretty much simple to understand. They're liabilities. They're obligations or debts that we owe as a business to other businesses. Okay. However, now let's focus a little bit on the owner's equity. And in a corporation, it's a little bit different. The owner's equity piece is a little bit different than it is in a sole proprietorship. So our owner's equities represent the claims that the owners of a business have against the assets of that business. Owner's equity is the residual equity that remains after deducting liabilities from assets. So if we look at it, we can change that accounting equation around to have it be owner's equity equals assets minus liabilities. So it's whatever is left over of our economic resources or our assets after we pay off all the debts. So how is the owner's equity different in a corporation compared to a sole proprietorship? Well, we mentioned before sole proprietorship, we were referring to the capital account and withdrawals and the like. When we have the owner's equity for a corporation, the owners are called stockholders, and then the owner's equity is therefore called stockholders' equity, or otherwise known as shareholders' equity. So when we look at the accounting equation of a corporation, it's slightly different. It looks like this. It's assets equal liabilities plus stockholders' equities. And our stockholders' equity can be broken down a little bit further. Our stockholders' equity consists of two major components. The two major components are the contributed capital and the retained earnings. The retained earnings of a corporation are just simply what they sound like, the accumulation of the earnings that are left in the business over time. The contributed capital, however, this is the stockholder's original investment in the business, and it consists of two primary things: the par value of the stock and any additional paid-in capital. The par value is an amount per share that, when multiplied by the number of shares that are outstanding, becomes the corporation common stock amount. It is the minimum amount that can be reported as contributed capital for a corporation. The additional paid-in capital is when the value that is received by a corporation when it initially issues its stock, when that value is greater than what the par value is. The amount over the par value is called additional paid-in capital, or paid-in capital in excess of par. Paid-in capital in excess of par. Again, let's look at this in terms of formulas. I think this is always much easier to understand when you reference it or relate it to formulas. So, our essential formulas here are our assets equals liabilities plus stockholders' equity. We can then break out just that stockholders' equity section and focus on that. And we see that our stockholders' equity equals our contributed capital plus our retained earnings. We can then take that formula, and if we're trying to figure out how our capital account or our stockholders' equity account has changed from one period to the next, we can do a formula that's very similar to that formula for calculating the capital account for a sole proprietorship, and that's this right here. We can look at it and we can say the beginning stockholders' equity and plus or add to that our profit or our loss. So we're going to either add or subtract our profit or loss. Add to that our contributed capital. So the contributed capital, remember, is the amount that the stockholders have bought into the company. Okay, it's the number of shares outstanding times the value that was initially placed on that stock when it was sold, minus the dividends, and that would equal the ending stockholders' equity. If we want to just focus on just the retained earnings portion of the stockholders' equity, we can do the equation: the beginning retained earning plus or minus the net profit or loss minus the dividends equals the ending retained earnings. Okay, let's move on to the balance sheet now. Here's a snapshot of a balance sheet for Inglot Consultancy. And again, we see a heading. And in this heading, we see the name of the company. We see that it's a balance sheet. And on this heading, we see that the date is just as of December 31st, 2000 and whatever. Okay? And again, we see our assets over here on the left side. And if we look and focus on the stockholders' equity section of the balance sheet, we can see that this is the common stock of the company that was sold, and then we have our retention of earnings, and then we have our total stockholders' equity. These two components, the common stock and the retained earnings, are added together to get the total for our stockholders' equity, and then the total liabilities are added to the total stockholders' equity to get the total of the liabilities and stockholders' equity. The last financial statement. Let's look at the cash flow statement. The statement of cash flows. This financial statement links the balance sheet, income statement, and statement of retained earnings. It explains the reason for changes in cash based on operations, financing, and investing activities during a fiscal period. It shows the cash inflows and outflows of a business, as well as the financing and investing for a business. It is organized into basically three major business activities. The operating activities, and the operating activities are just simply the day-to-day operations of the business or corporations. You should note that operating activities include the cash effects of transactions and other events that affect the net income, such as wages, the sale of goods or services, expenses, interest, taxes, inventory, changes in accounts payable, changes in accounts receivable. Those are all part of the operating activities of a business. You should also note investing activities and what they are. Investing activities have to do with the acquisitions and selling of long-term assets and marketable securities of a business. It is also the making and collecting of loans. Investing activities include the money from the sale of any long-term assets and any marketable securities. So if a business owns investments in other businesses, those would be considered marketable securities. And the collection or repayment of any loans, as well as the purchasing of any long-term assets or marketable securities. So if they purchase a building or they purchase a vehicle, those are all long-term assets, and investing activities would incorporate those transactions. And then lastly, you have the financing activities. These are when the business obtains resources from or returns resources to either owners or creditors. And the financing activities include when they would issue new stock in the corporation, any proceeds from any short-term or long-term borrowing, and any dividends or any treasury stock that the business acquires. Treasury stock is just simply when the company buys back shares in its own corporation. And we talked a little bit about that, but a lot of times businesses will buy their own stock back in the marketplace to boost up the stock price or show that the company is very positive, looking at as having a very positive outlook on its own financial situation. So again, this information is derived from both the income statement, the balance sheet, and the statement of retained earnings. So let's look at a snapshot of a cash flow statement. Again, we can see the heading, it's the name of the company, the type of financial statement and then this shows for the month ended December 31st, 2011. And we show here, again, we start with our cash flow from operating activities. And our cash flow from operating activities starts out with our net income. And then we have any adjustments to that net income, such as increases in accounts receivable, supplies, accounts payable, from any of those things that are the operating activities of that business. The next category that we see is the cash flows from the investing activities, and here we can see that the business purchased both land and buildings during the fiscal period, or this particular fiscal period, and we can see these are in brackets. These are in brackets because the purchase of land and a purchase of building, while their value and their assets that go on the balance sheet, on the cash flow statement, that's looked as an outflow of cash from the business. Okay, so again, we're focusing on the cash flow of the business. Pardon me. Okay, next we have our cash flow from financing activities, and we could see a positive impact here from our company issuing some common stock. So we brought $200,000 into the business, but then they sent some money out in the form of dividends. Okay, but overall, the cash flow from financing activities was positive during the period. And then we can see that we have a net increase in our cash for this business of $61,000. This positive impact can be traced actually to the change in the cash from one period to the next on the balance sheet. So if we were to look at the prior fiscal period, we would see that the cash had increased in this business by $61,200. So let's see how all of these businesses flow together. These financial statements flow together. Okay, so we started out with our income statement. That was our first financial statement that we prepared. Then we took the information, the net profit from the income statement, and we brought that down here, and we showed how it impacted our statement of retained earnings. And then we took the bottom number from our statement of retained earnings, our ending retained earnings, and we brought that down and we pulled it into our balance sheet in the stockholders' equity section of our balance sheet. And then we can see how this cash flow statement, the change in the cash from one period to the next, is reflected in the cash flow statement. We can see that since our business just started operations, there was no cash before, and that at the end of this period, there was a cash position of $61,000. Okay, so now we know what the four financial statements are and how they relate to each other. If we're going to be doing any sort of analytical work, we'll need to start looking at some financial ratios. Our financial ratios will show important relationships among the elements of the financial statements. The following ratios are very important ratios. We often call them predictive of a company's performance. Those are the profit margin, asset turnover, cash flow yield, and debt to equity ratio. We will be working with these ratios in the upcoming chapters this semester, but if we were to just take very simply the profit margin ratio, and we've looked at this before during the first half of the year when we've looked at the component percentage of profits relative to sales, and we can just simply say that the profit margin of a business equals its net income telling you this pen does not work very well. Net income divided by its revenues. Okay, sorry about that, folks. So that's the calculation for the profit margin. Net income divided by revenue. Okay, but what does that tell us? It's basically telling us what amount of profit the business achieved relative to the total revenues that it sold. So for every dollar of sales, how much profit did that company make during that fiscal period? Okay, that's what it's telling us. So for every dollar of sales, how much profit was derived from each dollar of sales? So as we progress through our chapters in this textbook, some cues to the information in the textbook. So when we're focusing on the financial statement elements in this textbook, the 6 elements on the top row on the financial statements are used to compute the 4 ratios on the bottom row. Okay, so the revenues and net income are for the profit margin. We can see that the cash flow from operations activities, total assets, total liabilities, and total equity, they each impact the asset turnover, the cash flow yield, and the debt to equity ratios. So, and the 4 ratios allow us to analyze the financial statements and determine how well or poorly a company is performing, which is basically what is the basis for what businesses use to make good business decisions. So how does all of this relate to what we would see in the global economy? Oh, look, I'm sorry, my slides have been misplaced. Look at this. This is the profit margin ratio information that I just spoke of. Sorry about that. I'm not sure how the slides got out of order. but here you see the profit margin is the net income divided by revenues. Okay, sorry. Focusing on the international practices. How does what we've just discussed relate to what happens internationally? As our economy and businesses become more globally dependent, the international financial accounting or reporting standards are becoming a much more significant component of what United States businesses are doing. The International Accounting Standards Board, or the IASB, has been working with our Financial Accounting Standards Board, otherwise known as FASB, to achieve identical or nearly identical financial accounting standards worldwide. The International Financial Reporting Standards are now required in several countries. And our Securities and Exchange Commission has recently voted to allow foreign registrants in the U.S. to use international financial reporting standards in the U.S. So that's an important shift, and we need to be keeping that in mind as we're looking at, the future and financial accounting in the future. Okay, so that's the end of Objective 5. And what we can see here is a little problem that I want you guys to work through. And it's basically taking the income statement of retained earnings, and the balance sheet, and you're going to calculate the different components of these financial statements and try to fill in the missing pieces. So in some of these statements, you can see that there are multiple numbers that have been omitted. You have to solve for those numbers that are omitted. So one thing to keep in mind as you work through this problem is to start with a financial statement where there is only one component of that financial statement that is missing. And I would lay these numbers out algebraically, similar to the formulas that I showed you back in that earlier slide. So every single one of those financial statements can be broken down into formulas, if you will. And I would suggest that you try to solve the problem by looking at it in terms of little mini formulas, okay? Such as assets equal liabilities plus stockholders' equity, or the retained earnings formula, beginning retained earnings plus net profit minus contributed capital minus dividends, plus contributed capital minus dividends equals ending stockholders' equity. And then, your net profit or your net income is just simply revenues minus expenses. So look at each of those in terms of little algebraic formulas. Next question is going to be, why is the balance sheet sometimes called the statement of financial position? You can put your answer. I will probably send you a link in Google to these questions. Now let's move on to the next question, which is to define financial position. You can put your answer. And then lastly, let's move on to Objective 6. And Objective 6, we're going to be working on generally accepted accounting principles and the CPA report. Objective 6 is going to show the relationship of generally accepted accounting principles to the financial statements and the independent CPA report. We're also going to identify organizations that influence generally accepted accounting principles. So let's look at GAAP. What is it? GAAP are the guidelines for acceptable accounting practices. They focus on the understandability of those financial statements, and they provide conventions or rules that and procedures that help to define how we should practice accounting. You've got to remember that the financial statements are prepared by management. They are audited or reviewed by a CPA firm to confirm that they are prepared according to generally accepted accounting principles, but it is ultimately management's responsibilities to prepare those financial statements. An audit just examines the financial systems, controls, and records, and then a CPA provides the independent audit report that confirms that generally accepted accounting principles were followed. And all publicly traded companies must be audited by CPAs. What we need to keep in mind is that when a CPA does its examination, they are not analyzing every single transaction that a business goes through during a fiscal period. They do an audit, they figure out what the financial statement, what the transactions are that they need to specifically focus on, and they do what's called an audit sample, and they audit that sample of the business's activities. Some organizations that influence accounting practices, obviously, first one, Financial Accounting Standards Board, FASB, and they are responsible actually for developing the GAAP principles and interpreting emerging accounting issues so that they can issue new GAAP pronouncements, and these are called the Statements of Financial Accounting Standards. The AICPA, or the American Institute of CPAs, this is a professional association for CPAs in the United States. The Securities and Exchange Commission, this is the agency of the federal government that has the power to set and enforce accounting practices for publicly traded companies. And then Governmental Accounting Standards Board. This is the body that issues accounting standards for state and local governments and municipalities. Next, other influencing parties are the International Accounting Standards Board. They develop, like GAAP for Financial Accounting Standards Board, these guys develop international accounting standards, and they issue international financial reporting standards. We have the IRS, the good old government taxing agency. They produce guidelines that determine taxable income, and including preparation and collection of taxes. And then we have the Institute of Management Accountants. They adopt a code for management accountants that they should follow. And lastly, the Public Company Accounting Oversight Board, PCAOB. This is a governmental body that was created by Sarbanes-Oxley to regulate the accounting profession. So what does all of this have to do with ethics? Well, obviously CPAs and business owners, business management should follow a code of ethics or a code of conduct that applies to the everyday life of these individuals and as it relates to their business transactions. And it addresses what is right and what is wrong. Professional ethics are basically the code of conduct that we practice in a particular profession. And for the CPAs, the AICPA has defined a code of conduct for CPAs, and that code of conduct basically encompasses 4 different areas: integrity, objectivity, independence, and what we call due care. Integrity is just that the accountants operate in an honest and candid fashion. Objectivity is just that they're impartial, and intellectually honest. Independent is that they avoid relationships that impair objectivity. So for instance, if you're a CPA and you're auditing a particular company and you're issuing their financial statements, you are not supposed to purchase stock or own any investment in that particular company. That would ruin your independence and in many instances also impair possibly your objectivity. Okay, and then lastly, due care, that you carry out the duties with competence and diligence. You know what you're doing. So then we have our questions for this section. What is GAAP? And why is GAAP important to readers of financial statements? Why do we care? And lastly, in terms of questions, we have that you should be able to discuss the importance of professional ethics in the accounting profession. And then just a little matching of the acronyms versus the descriptions that relate to those acronyms. So just be aware of what those acronyms are. Okay? And that about does it. So, folks, have a nice day.